3 minutes and counting, guys. 3 minutes and counting. Okay, good morning, Checkmate crew. 30 minutes after the opening bell, the New York Stock Exchange at 10 a.m. Eastern Time. Today is Thursday, January 12th, 2023. Yours truly, Mickey Blindside here with your market memo. Okay, guys, today CPI report came out. I guess that's what's on everybody's mind. Let's just take a look at the report. I mean, just because other people are talking about it, I have it right here. So it looks like the headline numbers came in at 6.5% year over year, with core, that's all items less food and energy, coming up at 5.7%. All right. We're looking to a lot of the disinflation for this reading came from the energy sector. So energy commodities, gasoline, fuel oil. It looks like those were the things. Oh, energy service. No, not energy services, but fuel oil. It looks like that is what contributed most to this lower reading. If we take a look at some of the other things, however, like if you look at services like shelter, for example, and shelter rents and real estate is, something that we've heard the Fed mentioned multiple times, and we're seeing shelter actually going up. So rents are still going up. We'll see how this plays into their calculus on what they do in February and March. If we look at I haven't checked the Fed funds probabilities since the CPI report. Oh, wow, look at that. So now with this CPI report, we are now overwhelmingly in one day, we've gone from like around 75% chance of a 25 basis point rate hike. Now it's a 93% chance of a 25 basis point rate hike. So that 50 basis point rate hike it looks like the at least the Fed funds market, the Fed funds futures market, is saying that that has a way more diminished chance than what was the probabilities yesterday. So it looks like February Fed funds futures market pricing in 25 basis point rate hike. It looks like there's another 25 basis point rate hike according to them on March, the March meeting as well too. The May meeting, it looks like we're sticking at 475,500, 475,500, 475,500 in July as well too. In September, 475,500, November 1st. So look at that. In November 1st, the chances of us getting a rate cut, a 25 basis point rate cut, has risen slightly, ever so slightly, okay? And then I'm just curious for December. Oh, another, okay, so has that percentage been increasing as well? The 425, 450, yes, it has. So with the possibility of 225 basis point rate cuts in 2023 for November and December. So right now, those are the changes that are in the Fed funds probabilities. And I think a lot of that movement happened right before the CPI, or no, I'm sorry, right after the CPI readings came out. So we'll see what happens. Okay. I'm not really too concerned about this report itself because, I mean, we saw this lower report coming. We saw the November and December reports going to be coming out lower. We anticipated this back from June, guys. So, for us here at Checkmate Trading, it really shouldn't be much of a surprise that this is what's going on. Let's take a look at the market's reaction right now. The market's reaction is that we are slightly down. The first initial reaction was positive, and I think we opened positive, and then now we're kind of selling off. Again, the market really has anticipated this. We went over this actually yesterday in yesterday's video, and if you click here on the top right, the exclamation point, I'll put some links to yesterday's video, but it's also in our market memo playlist. You can just go to yesterday's video, but we talked about how the inverse yield trade is getting more and more crowded, okay? More and more hedge funds and market participants are betting on the yield curve further inverting. So what they're doing is they're shorting shorter dated treasuries, and they're going long on longer maturity bonds. And, basically it's a bet that there's going to be further disinflation, there's going to be a recession, and then Papa Powell is going to come in and has to, he's going to have to cut interest rates. So that trade is already very crowded. There's a lot of people, there's a lot of there's a lot of hedge funds piled onto that trade, okay? Now, that doesn't mean it's going to unwind immediately. It may take months, which I think it will. It'll probably take until I don't know, maybe even March, April, in my opinion. Maybe then they might unwind, and at that point, maybe the crowdedness may be too much, and then we start seeing a stampede out the door. But again, the point of all of that is the market really, we anticipated this a CPI drop back in June, July, right? And we were right on November, December. After those November, December readings came out, everybody then was talking about disinflation and how CPI reports was going to come down. Okay, something that everybody thought was not going to happen. I remember when I told people that I expect CPI report to come down in November, December. People were laughing at me. Nobody saw that coming. Nobody except us here at Checkmate. Nobody else saw that coming. And when we finally saw that happening, everybody now wants to say, oh, okay, we're going to see disinflation. Okay, now we're going into recession. All right. And so now people are expecting all of this. Just because you actually get, these lower readings doesn't mean the market will always go up. Okay. Although in this few minutes that I've been talking about that, the market is recovering some of its losses. I mean, we shall see what happens. I care more about the closing prices than what happens during intraday. but at least that is the market's reaction so far. VIX is down. It looks like we were overhedged, and we were quite hedged for this. But that doesn't mean we still can't go down. Let's actually take a look at the VIX 9-day. The 9-day, oh, everything's down. VIX 9-day is collapsing. So, yeah, basically, I'm sure that if we look back, a lot of that volume in the last few days for hedging has been in the shorter dated and shorter dated puts and calls. And that's we've seen this phenomena now for almost the whole year last year, where more and more the hedging came into, in that 0 to 3 days till expiration on the S&P 500 options chain. Okay, but we are seeing VIX collapsing as those hedges come off, and we'll see what happens to the S&P 500 at the end of the day. The dollar index, I mean, this is still, oh, well, not so bad. Okay, so it was down way more. It was down way more, guys, and I really thought this is the day where I have to get rid of my UUP position. Okay, I really thought I was going to have to get rid of it. But now, hey, if it closes near here or if it goes up, I might keep it. And especially if it closes above where it opened today with that wick, that huge hammer, maybe that is a seller's exhaustion signal on the US dollar. It could be. I don't know. We'll see what happens at the end of the day. But if that would be, at least that would put my mind at ease for my UUP position. Again, my UUP position right now is just a hedge for some of the other positions that I have. The positions that I have, guys. So UUP. UUUU, Quad U, I'm hedging my Quad U shares on that right now. What is Quad U doing? Actually, I'm just curious with the dollar doing this. The metal space is probably really volatile as well too. Oh wow, outside day down. So we got a potential outside day down already forming on Quad U. The XME metals are also losing some of its gains. SILJ, I'm just curious. It was look, potential outside day down in junior silver miners. GDX also losing its gains from earlier in the session. Okay, so the dollar's doing its thing. Okay, the dollar's doing its thing. I would love an opportunity to cash out of those UUP hedges and buy the dip on, some of the names that we're going after. I mean, I would love to see that. I'd love to buy the dip with the UUP proceeds of my call, profits. I'd love to get into SILJ leaps and sell poor man's covered calls against that. Just because I want it doesn't mean we're gonna get it. So we shall see. Okay, we really shall see. But right now this hammer, this wick right here, looks kind of promising. Okay, looks kind of promising. We shall see. Again, we'll see. Since we're on currencies, let's just take a look at some of the other currencies right now. Euro, the euro is up. Some of our risk-on currencies are still performing. All right, Japanese yen is going up as well too. The British pound, however, not so much, it looks like. Okay, so will we see some of these risk-on currencies and some of these risk-on forward-looking indicators pare back and retrace some of their gains for the past couple of months? Could be. Okay, and maybe that could be the impetus for the dollar to go up just a little bit. I did want to highlight today though the emerging market currencies. So I think also too, we look at junk bonds, right, for our leading indicator for risk on, risk off, because that's just the junkiest part of the market. There's actually an even junkier part of the market than the junk bond market, and that is emerging markets. Okay, emerging markets. So emerging market currencies, are also a good leading indicator for risk on, risk off. And we have seen, that the dollar really has been chased after. All these emerging market countries, they would chase the dollar, all right, as the dollar kept going up, and they still need to pay their debts. Most emerging market debt is denominated in dollars, and so there is this mad dash for U.S. dollars once payments become due and the dollar is on an uptrend, because it just gets more and more expensive to service that debt. And in order to manage risk, they start hoarding dollars to make sure that they have enough to pay and service their debts. So we saw that from April all the way down to October. And then after October, we saw this huge uptrend. And now we see this higher high on emerging market currencies. Okay, so as long as that continues, if this keeps going up, we could see pressure on the U.S. dollar. A downward pressure on the U.S. dollar. But this could also retrace too. You could make a higher low, and that again would be an impetus for the dollar to go up. Hopefully we do. Hopefully we do get that, and again we can cash out of our UUP calls and do all the great things we want to do with precious metals. But until then, I just wanted to point this out. This for emerging market currencies, you can actually go on like different websites like investing.com and take a look at all of the emerging market currency pairs against the US dollar. Or you can use CEW, which is an ETF that invests and tracks the emerging market currency index, so to speak. Okay, so it kind of gives you an aggregate of what emerging market currencies are doing, and it's a pretty good indicator for risk on, risk off. Actually, this is a good indicator for junk bonds. Even sometimes this front runs junk bonds, but if we see this coming down a little bit, again the dollar could go up. But if this just keeps rising and rising and rising into next week and the week after, that's not going to be good for the dollar. That's just going to be headwinds for the U.S. dollar. So keep this on your radar too if you guys are trading the dollar, or if you guys are trading metals or materials or anything like that. I think this is going to be a good forward indicator for anything that is very sensitive to the U.S. dollar. All right. Next. Let's take a look at some of our treasury yields. We haven't looked at them in a while. Some of you guys have asked me what's going on in the treasury markets, so let's take a look. ZF, which is, the 5-year treasuries, it does look like it wants to continue its upward trend. We will see if it can make a higher high on a closing basis for the day. We're very close. Hold on, let's see how close we are. What is the highs here? The high here was 109.192, 109.18. So we're just shy. We are just shy of making a higher high and the ZF futures. Okay, if this can make a higher high, higher low, and keep on an uptrend, a lot of those US dollars that are in dollar denominated accounts overseas, like in Europe and in Asia, they're going to come out. Okay, they're going to come out of the dollar denominated accounts, and you're going to see some asset buying if we see this continue its uptrend. If not, then we could just see people hoarding dollars again in their dollar denominated accounts and just making yield, because again, TINA is no more. TINA was there is no alternative to stocks. There is an alternative if yields are high, and so short-term yields will have to come down in order for people to be incentivized to take those dollars out and put them to work somewhere else. So we'll want to see this go up. So that's with ZF right now. TNX right now, the 10-year treasury is holding stable. All right, it is getting stable. The MOVE index, which is the VIX of the bond market, is it hasn't really been spiking all that much. So we've seen a little bit of stability now in the yields market, which is I think the reason why we've been seeing more and more of that institutional demand in stocks, because when interest rates move very quickly, it becomes very difficult for institutions to price quote unquote fair value, because they base fair value off of interest rates. All right. Now, if interest rates are stable and they stay in a certain small range and they move slowly, then institutions love that. They know then, oh, this is the interest rate that we're going to use for for pricing in any type of cash generating asset like stocks, for example. All right. So TNX, it is being stable. If we look at some of our yield spreads, the 30 and the 10 is no longer inverted. Remember how we saw the 30 and the 10 inverted for much of the summer and fall? Now we're out of that. We're not inverted anymore. However, the 10 and 2 and the 5 and 2 are still inverted. Okay, so some of the more I guess medium term treasury spreads are still inverted. The 10 and 2 is a good quote unquote indicator for bank lending margins. So bank lending margins still are pretty compressed. It'll be interesting to see how the earnings look like for JP Morgan and some of the bigger banks that starts tomorrow. I know a lot of the bigger banks from a couple to a few quarters ago, they started shorting bond futures in order to hedge for that. We'll see how much of their hedging has helped mitigate some of that margin compression. I think that will set the tone for this earnings season on what the earnings revisions are going to look like for the rest of 2023. So that's really what I'm going to be looking for in tomorrow's earnings releases for all the major banks for tomorrow. And then in about 2 weeks after that, we got the tech earnings coming out. So it should be an exciting season this earnings season. All right. Crypto. Crypto still, the open interest on crypto, Ethereum, is still quite low. It is going up though. So maybe soon, maybe at this rate, maybe in a couple of weeks, we'll be able to get some insights out of the options market. But until then, I just don't see a reason for us to track that at this time. I'm just tracking that open interest, and I want to see that open interest go above $6.5 billion. I think it's in the threes right now, so it's not even worth looking at this moment. But Ethereum right now, remember that play that we wanted to do? I said it would be very high value if it touches this line and comes back down to 1241.46, at which point I'm willing to take an entry level position long on Ethereum at that point. Okay, well, lo and behold, look at that. It touched it. It kind of overshot, and now it's trying to come back into the underside of that upward trend line. So we're starting to get the setup for our trade. Okay, the setup is that it needs to make that higher high by touching this, and then come back and make that higher low at 1241.46, and that would be a high value zone to get long on an entry position. Again, the bulk of my buying, I don't want to do that until I get to this ETH gold ratio line. All right, I want this to touch that line, and then that's where I'm going to do most of my buying. But I'm willing to take an initial on this if it were to come down here at 1241.46. Now, this is only if our internal market data is still improving. And actually, let's take a look at that. The actual internal market data, if we yesterday, for example, on our junk bonds ADL line, we actually closed with a higher high. We now have a higher high now on the junk bonds advanced decline line. All right. Also, by the way, guys, I don't know if you noticed this, But if you look at the New York Stock Exchange high-low line, guess what happened, guys? We are now over all 3 moving averages. Now, this is a very good sign. We haven't seen this all year since end of 2021. So a little bit more than a year. So a year and a couple months. So since October, November of 2021, we have not seen this. We have not seen this go up. Now, it still hasn't made a higher high yet. In order for that to happen, it will have to go up just a little bit more. It'll take like a couple more weeks to make a higher high. All right. And then on that next pullback, that is when you want to go long. And then on that next pullback too, you also want to confirm that the junk bonds ADL line is also making a higher low as well too. And as long as both those things, if the New York Stock Exchange high-low line gets into an upward trend, as well as the junk bonds advanced decline line maintains its upward trend, that is a very compelling buy signal right there, okay? And you buy when the next pullback happens. So I'm already anticipating that, and I've already got some plans to buy the dip. And right now, as I mentioned, I think there's going to be uncorrelated markets. This is going to be more like a rolling bull market where the S&P 500 could be flat, or in a, I guess, more bullish scenario, during this rolling bull market, we could see the S&P 500 drift upwards, much like it did in 2017. 2017 was the last time we had a rolling bull market, and it did happen to drift upwards, but it doesn't have to be like that. We've had rolling bull markets where the S&P 500 was pretty much like flat for a few months, but within that structure, we see certain parts of the market rally and have strength, and then it kind of rotates between one sector and one group of stocks to the next, and it kind of just this bull market kind of just rolls from one sector and one part of the market to the next, and it's very, very low correlation, and that's why the index as a whole, the S&P 500 index as a whole, that's why you could stay flat, even though the individual components and maybe sectors, there are certain parts that are very, very strong. And I think where a lot of the strength is actually going to come in small caps and in tech in this round. Okay, in this round of the mini bull market rally and the rolling bull market, we may see. I think that the first round is going to be for tech and with small caps. Also, if you look at the New York advanced decline line, it's also making higher highs. When we see broad market participation and broader market breadth, it's usually a sign that small caps and Russell 2000 is going to outperform the indices. So we're already kind of seeing that right now. The IWM is doing extremely well. Right now S&P 500 is up 0.15%, but small caps is up 0.65%. Okay. So that just tells you kind of the relative strength right now in small caps. Actually curious, what's QQQ doing? QQQ is up only 0.15 as well, just following the broader market. So really we're seeing a lot of strength in small caps, and I think we're going to start seeing a new upward trend in the small caps pretty soon. So I want to get involved in that, and so that's why I already have this alert set at 171.50. But between 170.50 and 171.50, I want to get long on IWM, and I really want to get long on some in the money leaps that I can sell covered calls on. Will I get my pullback? I don't know. I don't know if we will or not. But if it does pull back, I'm ready. I'm definitely ready. I would love to see the dollar go up, the markets come down a little bit, volatility resume, and us able to cash out our hedges and buy some of this dip. Okay, so I'm in that mode. I'm in the buy the dip mode right now. Okay, so I'm telling you guys right now, that's what I'm doing. I'm in the buy the dip mode. You guys are free to do what you guys want to do, but the data is overwhelmingly clear now, and it's becoming confirmed that we are seeing strength coming back into the market. In different parts of the market, we're starting to see some strength. Some of our theses are playing out. We had this rolling bull market thesis since June. I told you guys that once we start seeing these outsized VIX spikes for small S&P 500 drawdowns, that will be the setup and the impetus for us to see this low correlation rolling bull market, which is going to be a mini bull market in a longer secular bear market. Usually this higher inflation, longer term secular bear market can last 6 to 10 years. We'll see like 1 or 2 years of down, and then we'll see like a year of up, and then it will continue down again. And that's something that we can see. It's a possibility. I'm not trying to predict the future. I'm just anticipating what could happen. But I think as far as 2023, at least for the first half is concerned, I think this is going to be the starts of again, mini rolling bull market. Okay, low correlated bull market, but it's going to be a mini one that I believe is going to be just in between a secular longer bear market that's probably going to last a few years. Okay. And if you want more clarity on that thesis, the last episode of 2022, the one that was done on, I believe it was like December 29th or December 30th. Again, I'll put the links on here on the recording of our YouTube. If you click on that exclamation point, I'll have a link to our 2023 and 2024 thesis video, which was the last episode for 2022 on the Market Memo playlist. But again, I'll put that link on there. All right. Anything you guys want to look at? Anything you guys want to see before we wrap things up? Going once, going twice. Okay, well then let's wrap things up. That's the end of our session of the Morning Market Memo. Our Discord invitation link is in the video description below. Come join our Discord, be a part of our growing community. There's no sub fees, no paywalls. It's of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. All right, I will be back on next week, Tuesday, Wednesday, Thursday, 30 minutes after the opening bell of the New York Stock Exchange. As always, that's when we'll have the Market Memo. Trade safe, guys, and I will see you guys next week.